February of 2026, is the market coming down, stabilizing, or going up? I think most of the country or most of Ventura County knows we're in a down market. But the question is, how much further is it going to go? Is it going to stabilize, or are we going to see prices come down significantly more? Right now, the exciting thing is, you guessed it, we're seeing some new price points open up. We're seeing 2 million plus properties selling in the 1.8 and 1.6s, and we're seeing the 400,000 and even one property in 3 when nothing was going below 5 over a year ago. So we're seeing some excellent price points open up, but what's going to happen? Is there going to be an inflection point this spring with the lowering interest rate? Is the war in Iran going to keep the oil prices too high and we have fears of inflation to keep the rates high? We're going to get into it right now. So thank you guys so much for watching. It's Jeff Belzer, living coastal in Ventura, Jeff Belzer Real Estate. We talk everything Ventura County. We're going to get into some national averages as well, but you know what I love to do? I love to pull that Ventura data every month and compare what's going on and what directions we're seeing. Also, I like to get into the sentiment that we're seeing in the market. So if you're staying for this, get ready. We're going to talk about what buyers are doing to strategize to get even better prices. We're going to talk about what we're seeing in open houses and how much volume is actually coming. And for sellers especially, are you going to price on the higher or lower side of your margin or possibility of sales prices? So here we go. Now, any further ado, the magic price that has opened up. I wasn't even doing this data a year ago as far as the 400 range because it really wasn't there. Things were selling at 500 up. Now there's 4 or 5 properties in the McKeons, which is the Montalvo area east of Midtown. It's really an entry-level neighborhood where you're going to have either the Shenandoah coming up in the 4s. We're seeing those in McKeons. I saw 4 properties listed at 435, maybe 5. There's 5 for sale over there, and they're not quite getting absorbed in a contract, which means that they're actually sloughing off. And most of these properties right there, there are investor specials, but they have out-of-area agents, which almost confirms. Now I'll need to call them up and find out what the story is. But when I see out-of-area agents, I'm like, okay, well, they bought it with an out-of-area agent, and they're selling with that same agent. So they've kind of realized we've hit the peak and it's time to sell. They bought the investment, short-term, long-term, whatever. They see what's happening and they see that things are sloughing off and they're selling these properties. And as it saturates with availability and inventory in that pocket, things come down. We did some really cool heat maps where we saw for price points. So when it goes 400 to 500, it's really focused in one area and it starts to spread out just a little bit. Our data right now, the big numbers is 158 for sale, about 160. So right as we get into March, it's about 160 units for sale. Now I want you guys to pay attention to is when you look at all MLSs, when you look at all available properties in the city of Ventura, our inflection point was 200 to 210 last year. So if we don't get above 180, prices are going to hold strong and maybe even rebound and start kind of ticking up again because we are in a little bit of this buyer's market right now, or full-on buyer's market. But we want to see how long that buyer's market's going to last. So inventory is the key, even more than the interest rate. The interest rate is pretty much stabilized at 6, and it's going to go up and down a little bit as things prevail. But the inventory is the key thing that can change. So if we get up another 20 units and we get to 180, that's typical. But when we hit 200 and 210 last year, and that was enough for activity to happen, but it was also enough for things to still be slipping off 5 to 10% in price. So if we blast past 200, let's say it doesn't look like we're going to hit that in March, but if we blast past that in April or May, and we get up to like 220 or 230, yeah, for certain, we're going to see prices come down. So I see a lot of this in the open houses. There's not as many people coming through. There's not as many people coming through ready to purchase. A lot of them are thinking about moving. They're thinking about sailing. They're dealing with the idea, but they're not really pre-qualified. Even if they're excited, even if they're fit, whether they're fit or not for purchase, it's just a lot of like speculation and, kind of what I call maybe babies. Like, well, maybe it'll happen. Maybe it won't. But not where it's like juiced up, where people are coming in, ready to purchase. Then all this is price sensitive. So those are the larger inventory levels. So 5 to 600, it gets stronger because 5 to 600, you've got a higher quality product. So from 4 to 500, you're not going to get as many people biting off that because people kind of don't want it. A lot of times the mid fours, it's kind of a fixer property. It's not the most desirable property. However, if that's your first time home purchase, you have to do it. You will never catch up in savings, and it is too difficult to time the market because by the time you wait for the right time, we will be in the bounce and you'll be competing again. So if even if 450 is the time, that's what it is for you to get in. Now's the time to get in while we're in the buyer's market, because I know we'll be in it for 2026, but I don't know if we'll be in it for 2027. I do know for a fact, if things continue as they are, we will be in a down market for 2027. But something has to change for this cycle to change. We've been in the same narrative of the Fed talking about lowering interest rates. They haven't really done anything significant, even though there's been a lot of this, printing of money, buying of bonds. But here we go going into Iran. There's things that kind of balance the good news with the bad news, and it's kind of just staying the same as far as home purchases and sales. And the same is a decline. Now we are seeing some special properties that have been kind of over embellished, that are highly desirable areas, highly desired neighborhoods that are kind of like the best one in the neighborhood, the best one in the street. Those go up because that's what everybody wants. They all want the best property. So the best properties at the best price will still get multiple bids, but almost any property that's overpriced 5 or 10% and they're chasing it down, if you're a seller, you're likely to sell it for 5 or 10% less than the market value rather than 5 to 10% over if you list too high. This is list low on the lower side of what your scale is, then see what happens. Not list high and see what happens. That's not going to work out for you. Okay, so now our prices between 7 and 800 is very strong. 9 actives, 10 in escrow, 6 closed. So 9 actives, 8 in escrow, 6 closed, and then 8 to 900 is very strong. That's 17 active properties in the 800 range. So if you're shopping in the 8s, you've got inventory to look at. 14 were absorbed and 18 closed. So that's a strong absorption because you've got 17 active, 14 are absorbed, the other 17 left, but they're getting sucked up quick. Those are probably going in like a 1 to 2 month scale. And our average 158 to 52 closed is about 1 out of every 3 properties for sale. Now, when I get into the luxury properties, like if you've got a $2 million plus, you've really got to pay attention when we get there, because those luxury properties, they're going to be like 1 to 6 or 8. And a lot of the competition hasn't even shown up yet. Those sellers are coming. Okay, so then we've got the 9 to 1 million. That's actually our strongest and has been last year. Our strongest price point is 900 to a million. It's where you really see a big jump in quality of home. So if a home isn't of the quality of 900,000, a lot of times it's going to need fixes, repairs, and sometimes we don't know how long that goes. But in the 9 to 1 million, we're seeing properties that are in pretty good shape. Midtown, East End, and the West End, they're in pretty good shape. They've been well taken care of, and you have something of quality to get after. And that's really where the middle is buying. So that's 10, 9, and 9, almost a perfect absorption rate. And then 1 to 1, you've got 6 active, 1 pending, and 2 closed. So that's kind of an inflection. So the 1 to 1 is a little weaker. So those are probably selling and closing lower, below the million. And then you've got the 1-2s are actually probably the ones that were dropping in from 1-2 to 1-3. So 1-1 to 1-2, you've got 9 actives, 5 absorbed, and then 2 closed. So we're starting to get the actives are going up and the closed numbers going down. That's what we're looking for. This is all price sensitive. And then once you get past, so 1-1 to 1-2, once you get past the 9, 5, and 2, you enter the 1-2 to 1-3. And then I've got this circled. So 1-2 to actually 1.8, you've got a lot of listings and you have hardly any closeds. So the big inflection point, so 1-2 to 1-3, 8 listings, 1 escrow, 1 closed. So if you're selling in that 1-2 or 1-3 range, there's not a lot of buyers out there for you. Then 1-3 to 1-4, you've got 11 actives, 2 in escrow, 1 closed. So you're trying to say okay, well, every third on average in Ventura is selling. But if you've got 11 and only 3 properties, now you're at 1 in 4. And in some of these cases, it's like 1 in 5. So if you've got 5 properties in your neighborhood and you're the highest one priced and they're about the same quality, you're not selling. You have to be competitive as a seller, and it's not just your neighborhood you're competing against. You're competing across all neighborhoods, and you're kind of competing across the county as well. Some people might be looking at Camarillo or Oxnard. Some people might be looking at Camarillo, TO, Agoura, Westlake. There's a lot of price points, but especially between 900 and 1.2. There's like 70 properties on right now. That's a ton of competition. And I was looking for some clients, and it was difficult just to figure out, okay, which ones are really going to speak to them, like what they want, the vaulted ceilings, the renovated kitchens and baths. You have to like cut out a lot of properties. So if you're one of those properties and you're a seller, you're literally getting cut out of the mix of the views. So if you want to get sold, you want to exit, you've got to price accordingly. So that's what we're seeing. So the 1.4 to 1.5, that's where we kind of saw a moment there with the 1.4 to 1.5. We saw 5 actives, 3 escrows, and 0 closed. So we're seeing more in escrow at the 1.5 range, which was really neat. So the 1.5 to 1.7, 8 actives, 1 absorbed, and then 3 closed. So we're seeing some activity, but a lot of those, let's say 1.5 to 1.8, those probably would have been priced higher last year or the year before. So the buyers are definitely getting better properties for their price, like today. Like it's happening. People are getting better bargains on the buy side. Now the next inflection point here is that 1.8 spot. So that goes from 10 actives, 0 escrows, 0 closed. Guys, that's huge. That's a 0. And then we see the next category, 2 to 2.2, 0, 2 to 2.4, 0, 2.4 to 2.6, 0, 2.6 to 2.8, 0, 2.8 to 3.1, 1. As far as closings, like they're not shopping. Luxury's not shopping right now. Now they're probably going to shop this spring when the better deals come on. So if you're relisting, if you're expired or you canceled and you're going back on, you've got to get so tight on your data. You've got to look at this wide scope, the narrow scope, and then what's relevant to your property. So the 2.4 to 2.6, that's actually like a pretty good point right there. We're seeing 5 properties actives and 3 absorbed. So you can sell at the 2.5, but it's probably yesterday's $3 million property. So all of these so-called gains of what your property's worth what someone's willing to pay for it. And a scarce market, we have thin inventory, it's very competitive, and the only people out there are the ones with money, and there's few of them. Yeah, you're going to get those prices. But we are in almost a perfect opposite reaction to that pandemic market of ridiculous that we saw of waiving inspections and contingencies and going 200 ask and giving a seller everything they wanted. Now here's what I wanted to get in. You know how the buyers are doing now? You know what the buyers are doing? They might go view a property, love it, and then they wait like a week and they check in. And they check in again. They're not afraid to lose it. They know another one's coming on. They're not afraid to lose it. And they wait. Then it comes on and they write an offer lower than what they said they were going to write. And then you negotiate, you get under contract, they know everything about the property. And then during the inspection period, whether they do the inspection or not, they're just asking for money off. So if you don't hit an escrow within the first 2 weeks of 30 days, the type of buyers, the mentality of days on market is the worst thing. The last couple of years, having my own personal properties, having clients' properties where either I was too ambitious or they were too ambitious and we're up and we're high for too long, and I took over some expireds too. When I talk to people, it's about being honesty and getting on that number. So I know this number now, so doing that reach thing is not going to work. And then we've got other folks where they were high for so long. Everyone, these buyers, they walk in, you know how they do? They walk into the house that they've been looking at and salivating on Zillow or Trulia or Redfin or whatever. They walk in and they just kind of go, oh, it's kind of nice, big house. How many days has it been on the market? And they act all like they don't know. They've been watching it the whole time. Like they know. And then when you hear you say that big number, the right thing to say as well, only about a week at this price, or 2 weeks at this price, as you just did the reduction. The problem is that they've got a number that they're willing to pay, and it's lower. So because all of those buyers in a thin market have absorbed and bought and gone into escrow and bought something else, there just aren't as many out there. Now I feel like we really do have liquidity still out there. We've got people wanting to do things, but nobody wants to overpay and everybody wants to get a better deal if they can. People like to know we've hit the bottom. The thing is I don't think we're going to hit the bottom anytime soon, but I don't think we're crashing either. It really feels like this is a slow bleed down. We're going to lose 2, 3, 4, 5% at a time. Not every quarter, but throughout the year. Each year we'll probably lose 5 to 10%, depending on the price point and the quality of that property. And we'll see it slowly slide off, probably for this year and next year. The thing about it is that most buyers don't know is that, yeah, that seems like a long time, 2 years away to try to wait for an inflection point. That's how real estate works. It's a slow lag measure. And by the time we get to 2027 and things turn around and there is some sort of like economic emergency and they, buy bonds and lower interest rates again, and we end up anywhere near like the 4s or the 3s, it's going to be very aggressive out there. And then we're going to be in a very different market coming out of last recession, because last recession, it was most of the homes. But this time around, we're still going to have that incubating equity where 40% of the homes are owned outright. The next 40%, they have the low 2 or 3% interest rate, and you only have a fraction of people really motivated to sell, or a smaller fraction of people that kind of need to and that are underwater. We're not in a foreclosure situation. We are in a buyer desperation. The only time the buyers are desperate is that they really, really need to move now, and they just kind of have to sell it for whatever they get. Or a lot of times what we're seeing is it's an inheritance. It's a probate property. Let's just get everyone paid out. Let's get what we can get. We thought it was up here, and it's down there. There's a ton of those. That's happening in Ventura, Santa Barbara, TO, all the time. It's kind of like that's the way it's going, is people are just kind of aging in place, letting properties go. All of a sudden, people are getting them. They don't really want to put any money into them or fix them up for the sale. And it's like, let's just get rid of it. So those end up going lower. Another thing is the buyers, they don't want to be doing the renovations. So you might have an excellent property that's dated 70s or 80s, and it's kind of vintage and it looks cool, but insurance doesn't want to pay for the old electrical. That's a bargaining chip. And buyers don't want to pay to renovate everything. They really don't. They're putting huge down payments down. In some cases, they're paying a little bit of commission, and it's just they're putting so much cost on the buyer that we're seeing a reaction to that. So if you guys are out there hunting around, a lot of this channel will produce buyers that are coming from other areas. So if you're out there hunting around, don't feel like, oh my gosh, we've got to move so quick. Yeah, there's inventory, but this Ventura market moves slow. You've got to know when to go shopping. So as the inventory beefs up this season, be ready to take action this spring and this summer. And then when we get into the fall, be ready to look for the leftovers. We won't see as many properties hit the market. We'll see some. We'll see some new ones, and you're going to compare the ones that were sitting there to the new ones coming on. The ones that tend to come on in the fall are the ones that have to sell, that aren't prepped, they're fixers. We totally got dumped on in the West End. We had those listings there, and and all of a sudden we had 3 or 4 properties come on that were fixers that were super low priced. So it really affects the market. So I want to say thanks so much for you guys for watching. This is our monthly market update. Like and subscribe if you haven't already. And I've been seeing lots of people come to open houses. That's where I'm meeting people more than online. But if you want to drop a message and you have a question, by all means, let's get in touch. You can text me or do a DM here or a comment. Yeah, and if you guys are sellers, like the sellers, you guys are the ones that really need to be reaching out, because we've got data here to prove it. At Sotheby's, we've got some incredible marketing materials and data for you to see, so that you know exactly where you're at. This is a broad view, but when we get to the neighborhoods, we can get a more more of that macro view and just really get in on the micro level, tune the neighborhood into the street. I just produced one. I did one 2 years back on a person's street, and then I did 1 year back on their neighborhood, and then the last 3 months, because the last 3 months were significantly different. But it's going to be a good ride. I really think we're going to see it bustle for the spring for 2 to 3 months, and I think that's going to be it. Without an interest rate drop, we're not going to see it bustle in the fall. We're going to see things fall. If we're anywhere near the 6s in the rates, and we're anywhere near 200 as far as inventory, yeah, we're coming down another 5 or 10. All right, thanks you guys so much for watching. We'll see you later.